Hey, what's up, folks? This is the February 2022 monthly market update, where we are going to be going over all the major headlines that I picked out of the news this past month. If this is your first time, or you'd like to check out older investor letters of other monthly reports, you can go to simplepassivecashflow.com/investor letter. If you're checking this out live on our Facebook group or YouTube channel, you guys can type into the chats. I will reply back to comments or ask any pertinent questions that you guys like. We want to try and keep this interactive, but this gets also put up on the podcast, simplepassivecashflow.com. But let's get into it. Welcome, everybody. This is the monthly market update. Here we go. First thing before we get going, my book released recently, The Journey to Simple Passive Cash Flow Real Estate Investing for the Working Professional. Hit bestseller. Thank you all for helping out, buying the Kindle book for $1. And if you guys are able to write a review, we will send you a free hard copy. So though you guys are bargain hunters, I guess, buy the Kindle book, leave a review, take a screenshot of a review, and then email it over to team@simplepassivecashflow.com before, let's just call it the end of this February, and we'll get you a free hard copy as a thank you. You guys haven't met me. I'm an engineer by trade, quit my job several years back. Today, over 7,500 rental units, over 45 plus property projects, $1 billion of assets under management. And first thing here, what happened to the eviction tsunami? Now, I think this is a narrative that was going on the last couple of years during the pandemic, and that narrative was, well, with all the moratoriums of non-evictions happening, well, what's going to happen when all these, the moratoriums go away, and there's going to be a huge flood of people out there. So, just quoting here from the 538 article, some observers think that social policies like the eviction moratorium, stimulus payments, extended unemployment insurance, and rental assistance have started off disaster. Others think that mom and pop landlords who tend to deal with lower income tenants have been more accommodating or reluctant to lose tenants than expected. And I will say that that is what I have been noticing from a lot of the mom and pop landlords out there. They are kind of like scared. They don't know how to react to all this. So they've been bending over backwards to accommodate tenants way more so than what we are as professional landlords, or at least our professional property management companies, commercial property management companies are handling this. So it's very bifurcated. You have the professionals kind of running their assets a certain way, and then the mom and pop amateurs doing it another way. And they were dropping their rents or going month to month. We're kind of taking a hard stance and using this as an opportunity to get the people out that shouldn't be there to improve the community. Joint Center for Housing Studies from Harvard University reports that the boom in home modeling may be in May of 2022. And if you guys are checking this out on the YouTube channel, we have a little chart here that's showing the projection later on in the summertime. So what does that mean? Strong increases in home sales activity, household incomes, and home equity levels are supporting a faster expansion of the home remodeling market over the coming years. And part of this was a lot of people were stuck at their homes. They were looking for something to do, had a little bit more home equity. So it's kind of that perfect storm for more home remodeling. And as we all know, like, last year about this time, lumber started to skyrocket. That kind of went down and then a little bit up. Not as bad, but it is a little bit up at this point. The rising cost of labor and construction materials, difficulty retaining contractors, and climbing interest rates could discourage owners from undertaking new or larger remodeling projects. So if you believe what the hardware university is saying, they're kind of saying that a lot of these prices may kind of hit that peak in May again. Fortune says Wall Street profits on Zillow woes by gobbling up starter homes and investigation fines. So if you didn't hear, spent last year aggressively expanding a home flipping operation designed to make $2 trillion of US real estate better for consumers until a bad bet on home prices pushed the company to pull the plug. Zillow's efforts to sell off its inventory of thousands of homes has highlighted a little noticed truth about the business called iBuying. So it's kind of a little bit of a fiasco. You guys can Google it for more details. But the transaction raised questions about the role of iBuyers are playing in a housing market starved of affordable properties, both for rent and purchase. A diverse range of U.S. political voices, from the Biden administration to the conservative television host Tucker Carlson, have blamed institutional landlords for crowding out regular families. And this might, I mean, it is what it is, right? Like, I've never wanted to be political on this podcast or YouTube channel, because I think it's a waste of time. But I think it's important for investors to understand which way the puck is going. And unfortunately, we are becoming more and more a nation of renters, and therefore a lot of the institutional players out there are getting more involved in spaces to capitalize on that long-term trend. So what do you do? Well, if you're like a landlord or you're an investor, you get on the right side of that and you buy some rental properties, duh. Or you go into syndication deals where you can also get involved in that action and play that bet. Commercial property executive reports inflation fears in commercial real estate. Found that commercial real estate performance has been good during periods of high inflation, and the returns are much more closely correlated to the growth of inflation. So I mean, this is, I think, if you've been following the market, we're in a bull market, folks, and inflation is high. Um, you got to kind of invest and get your money out of your lazy assets, out of your home equity, your rental properties, your your retirement accounts and the bonds. I mean, the bond market has flipped. It's not the bond market anymore. You got to get your money out. I mean, the junk bonds, which are the crap bonds, the bad debt, um, it's making a lower yield than inflation. I mean, think about it. That's crazy. Forbes reports that real estate billionaire Sam Zell says office space will rebound faster than retail. Uh, Office space got kind of hit with the whole pandemic for obvious reasons, because people tended to stay at home and not go to the office, and occupancy came down. And some big, more tech companies, especially in the coastal markets, they allowed a lot of their workers to work more remotely. And right now we're in a sort of a worker climate where a lot of the power is going into the hands of the workers as opposed to employers. But I'm sure that'll turn at some point once again, maybe in the next few years. But right now, employer says you have to go back to work in the office because we want to babysit you. And then the worker right now is like, screw you, I'm gonna go and search for another job a- in my boxers because I'm at home and I can go and also do an interview virtually. And we'll see if I'm still here when it's time for when you're gonna force us to come back to our work. Major companies including Deloitte, Facebook, Google, Lyft, Salesforce, and Uber have allowed workers to work from home, the office, if they are vaccinated, but do not require employees to work full time in the office. Now, that is the more of the, I think, on the cutting edge of employers. We have to remember that most of the employers are more old school. They work in their employees are not over six-figure salaries. Most of the folks working in cubicle land are much less than that, and they, in my opinion, they need direct supervision and need to be in an office. RE Business Online reports that Florida and Texas dominates the U-Haul's top 25 growth cities. So what the U-Haul report is, for those of you guys don't know, is something that the U-Haul, the trucking company, which are supposedly models more of the budget conscious folks out there, which is exactly what I kind of like to invest in, which is the more of that workforce housing, the lower middle class type of clientele. So to kind of follow where the U-Hauls are going is kind of makes sense as opposed to the van line report. The van line report kind of tracks the white collar movement because when you're a corporate worker, white collar worker, a lot of times you get that white glove service of moving when you are relocated with the van lines. Um, whereas we can all remember when we were broke college students in the U-Haul moving ourselves. Uh, So it's not just people moving to Florida, businesses moving because they see better opportunities there. Florida has always been a destination for retirees. Outside of Florida, Texas also popular landing spot. California ranked last among U-Haul growth states in 2021. Still, the state had a couple of pockets of growth with Sacramento ranking number 8 and San Diego ranking number 12. Commercial property executive reports that Phoenix's booming industrial market, so this is more the industrial asset class, because the Phoenix geographic area, proximity to California is its greatest asset. A lot of land and strong labor pool, and industrial buildings are investments for their developers, owners, and tenants. Different articles, six major movements for Phoenix in 2021. Things to watch out for is number one, the semiconductor and engineering plants. And if you guys aren't following this, it's kind of an important thing out there is the whole where is the semiconductors fabricated. Right now, the best ones are in Taiwan, TSMC, Taiwan Semiconductor Manufacturing Company. So if you want to sound cool in front of your colleagues there, you could just start talking about the battle between Intel and TSMC. But a lot of that is going into um, Phoenix, and Electromechanica broke ground in Mesa, Arizona, where they'll also be creating an assembly and engineering plant. The next is the Paradise Valley Mall redevelopment. Third is their transit road upgrades. The city adopted cool pavement system, which applies reflective coating to streets lower the extreme surface temperature. Something I actually went to college for was pavement design. Don't use it today, but I kind of know exactly what that cool pavement system is. It's just a computer programmer that and a reflective coating. The South Central Extension Downtown Hub will connect the following light rail system in downtown. That's another expansion. Number four, Howard Hughes Corporation's $600 million investment. This is a master plan community in the Douglas Ranch in Buckeye, which is just northwest of the Phoenix. Number five, the state's first timber project from Mortensen. And number six, Facebook expands data center footprint. They acquired 390 acres of land, which can be built out to 3 million square feet of development over the next few years. So some of those are some of the latest developments in Phoenix. Multi-Housing News reports the financing solutions for the missing middle. And when they talk about the missing middle, they're talking about that middle class folks. Maybe some of you guys are middle class, although it seems every day that the middle class is a dying breed and either lower middle class or wealthy. So in the government sector, the primary mechanism for funding affordable housing is the LIHTC. I don't know why I call it the LICTA, but that stands for Low Income Housing Tax Credit Program. But this is where donors can play a critical role in raising funds to supplement government subsidized initiatives. But if you're really looking to make money, you don't build affordable housing, um, even though it's the right thing to do, in my opinion. I'm kind of looking into doing that, especially in Hawaii, where we don't have any of that type of stuff, and Honolulu City and Cook County can't permit to save their lives, even though that's the right thing it should be doing. But anyway, moving on. Right, like I said, no politics. For the investing community at large, bond financing offers a risk adjusted low interest investment vehicle for the potential to make major impact on the affordable housing crisis. The simplest way to make such an investment is through social impact bonds that carry an identifier such as CUSIP, Committee on Uniform Securities Identification. This number identifies a financial security for facilitating clearing and settlement of trades, which is generally perceived as a simpler vehicle for investment than private equity. San Antonio is the top relocation destination for Austin renters, reports said. So just like how we were talking about people moving out of California and maybe going to different parts of the state that were a little bit less overheated or expensive, we talked about in California, Sacramento, people moving from the Bay Area up to Sacramento, maybe from LA, moving down to San Diego. But people in Austin, Texas, which has been kind of a hotbed for tech and growth and development there, they're moving, a lot of people are moving out to San Antonio, which is the overwhelming majority of these searches were coming from Austin. Houston was second with 20% of all the other searches, while Dallas was third with 8.2%. This is, again, internet searches from apartments list users. Out of state new renters were likely coming from Orlando, Atlanta, and Chicago. San Antonians are looking to move to Austin, with the majority of local outbound searches, 18.5% looking to for the going into Austin. And then they are also going to Dallas as the second most popular relocation station. And again, we're talking about San Antonians. Adam reports that home ownership in the U.S. again less affordable in the fourth quarter as prices keep soaring. No brainer, right? This has been the narrative for a little, almost a year now. Median price single family homes are less affordable in the fourth quarter compared to historical averages in 77% of the counties across the nation. The largest are Cook County, which is Chicago, Harris County, which is Houston, Dallas County, Texas, Bexar County, San Antonio, and Wayne County, which is Detroit. Quarter one, Arbor reports that quarter one 2021 small multifamily metro cap rate trends. So through the first quarter of 2021, smaller metros experienced more cap rate compressions for small multifamilies. A lot of this is just, they call it cap rate compressions or rates coming down, but it's a lot of it is also paired with lower interest rates. And this is why I say I'm not super concerned if interest rates go up, because the cap rates will likely go up, because what happens when interest rates go up? Well, that means the government, the not the government, but the economy is doing well. And inversely, when the economy is doing bad, the Fed lowers the interest rate. So if you're already investing, you shouldn't really worry about the interest rates go up, because first of all, you're kind of locked in, or you have the ability to lock in your rate as it starts to creep up. But if you're into rental real estate, in a way, you've kind of you've got a multiplier effect on those rents. The rents will skyrocket on you, and you don't really care what the interest rates are at that point. Multi-housing news reports that Freddie Mac forecasts continued multifamily growth in 2022. We're seeing definitely an upward trend in transaction volume. The biggest lenders are Freddie Mac, Fannie Mae, life insurance companies. That is why life insurance companies are so stable, and that's why we do the internet banking strategy, which use them as the backer. CMBS, and then other strong. The reason why they're saying this is strong economic conditions and unprecedented levels of demand for multifamily housing has led to strong conditions in 2021. However, the report also mentioned that 22 still has uncertainties, more specifically increasing inflation and the more transmission Omicron variant, potentially slowing down economic conditions. Says the weatherman who always has to cover their backside because they never want to make like put themselves out there. Multifamily executive reports that no signs of multifamily market slowing down. They are citing higher demand, lower volume, potential tax law changes like the 1031 exchange and capital gains were a major motivating force compelling transactions in 2021 that otherwise would have happened 2 or 3 years later down the road. Transactions are leveling off and numbers for 2022 simply won't be as high. And again, we're talking about more transaction volume. The multifamily resilience during the pandemic was a catalyst for interest from investors and other commercial real estate segments like office, hospitality, and retail. Multifamily outperformed other asset classes, and coming out of the pandemic, the market is seeing the best operational performance on record, which is why you're seeing a lot of institutions seek refuge in multifamily. Second and tertiary markets take the lead. So renters move out of major cities like New York, Los Angeles, and San Francisco and into the suburbs and smaller MSAs. While the ongoing migration is likely linked to more affordable rent prices, Yardi, in its multifamily national report, notes that lifestyle rentals continue to grow at a swift pace. And lifestyle rentals are the folks that um, I believe that's the people that have to do that or they have to rent. Uh, they describe no, actually, the lifestyle renters are the people that are on the higher end, the richer people. The renter by necessity is the people that they deemed as workforce housing or the people on the low end, which are also going up. But the lifestyle renters is going up at a higher pace. And they're also citing versatile financing options. Non-traditional lenders are getting into the space, and that is because of, like I just said, institutional money coming into it. And the institutions, they not only buy the assets, but they also get into the lending side of it too to play the deal. Pandemic rent growth highlights migration patterns. Um, s- some of the rents grew by 34% on the Southwest Coast, 31% in Phoenix, 28% in Tampa, 28% in Vegas, 27% in Boise. Next one were Ashland, Atlanta, Orlando, Raleigh, Durham, and then Charlotte. Bloomberg reports that apartment occupancy just hit a historic high. High occupancy rates leave little margin for renters who need to relocate for jobs, education, or other reasons. Good time to be an owner. Demand for housing continues to outpace the supply. In this specific moment, the Omicron surging and rental chaos, a recent memory, many landlords will stick with their current tenants, no matter the housing shortage is so severe that property owners likely don't need to charge max rents to make a bundle. Families that do not need to move right now face tough choices or fewer choices because there's not enough housing stock for them. So if you're a sophisticated investor, I mean, you really can kind of ring the higher rents, is what I'm saying. And that's why we were saying earlier, the mom and paw unsophisticated investors are the folks that are kind of getting killed through all of this the most. Mortgage rates start 2022 with an increase. So we talking about this is not a huge thing in my opinion. With higher inflation, promising economic growth, and a tight labor market, we expect rates to continue to rise, which I think that's what the Fed should do. The Fed should be raising the rents or raising the rates because of the rents are raising too. Um, but in tough times, you want to be grabbing more of this dry powder, which is increasing the rate so they can lower it and stimulate the economy. And this is what the Fed is supposed to do. I'm sure there's a lot of other things that's going on behind the scenes that I don't understand. But when in good times, they increase the rates to slow down the growth, to keep it under control, and to kind of elongate it out, smooth out the curves, the ups and downs. And in bad times, they lower the interest rates to increase the liquidity in the market. Very simple. So if you're in a situation where interest rates are increasing, well, Luckily, you have your rates locked in, or you lock in right away, but you also are the beneficiary of a better market because that is the situation where that happens. Uh, Mortgage Bankers Association forecasts the 30-year mortgage rates will reach 4% by the end of 2022. Drivers of the rising rates include a more hawkish Federal Reserve, a strong recovering economy, and a large federal budget deficit. So I don't know how much the rates will probably go up, but I mean it just it doesn't. I don't think it's nearly going as much as how much inflation and rents are going up to keep pace with that. Wealthmanagement.com reports that demand for downtown apartment properties has fully rebounded. Apartment investors are spending money faster than ever. They are following renters who return to downtown neighborhoods, even though that many of these renters still work from home in their luxury apartment towers. Percentage of apartments that are vacant in these downtown submarkets is now lower than it was before the pandemic, and average rents are rocketing higher. So in the beginning of the pandemic, you had a lot of people starting to realize, well, why the heck am I if I'm here if there's nothing's going on? And that was the whole reason I was here in the first place. They kind of moved away a little bit, and now they're kind of returning back. Is kind of the world is returning back to order. Only two downtown suburbs, Seattle and Houston, didn't have asking rents higher than the levels were reported in the fourth quarter of 2019. Apartment rents are still lagging in San Francisco, Minnesota, and pockets of Washington, D.C. Manhattan, the entire island, stands out as its asking rents has lagged the 14 downtown markets in terms of asking rent growth in 2021. Houston apartment fundamentals break records in another sudden turnaround. Relative to income produced at apartment properties, prices in Houston are still high and rising, pushing the yields investors expect lower and lower. Rents up 11% in 12 months. Joint Center for Housing Study from Harvard reports that what renter resources have renters tapped during the pandemic. And this is where we got involved. We had our property management team sit down with a lot of the tenants to apply for a lot of these government programs. Some of these are listed here. There's a lot of ways that you can get money if you don't have the money. It's just a matter of being educated. But that's it. Oh, I guess the final tip here is, if you're a landlord, you really should be looking at these ways that you could be getting money, and I'll just kind of read them out. I mean, the regular sources: income, credit cards, savings accounts, borrowing from families and friends, unemployment insurance, stimulus payments, SNAP. So SNAP is the thing that we've been kind of helping people get. Um, it's different every state. Please don't ask us how we do it because I don't know. That's what the property management team's job is. So they actually sit down with the tenants, they do it. But might be something if you're a little mom and pop landlord and somebody is falling behind. You can get some brownie points, I think, if you do a little Googling for them and say, hey, just fill this out. You might be able to get some free money from the government. But before we get going into my more personal report, if you guys haven't yet, please check out the Family Office Ohana Mastermind. If you guys have scoured the interwebs and seen a lot of other groups out there, you start to realize that your network is your net worth. Our scope of this group is to find deal flow, figure out who not to work with, more importantly. Taxes, legal, infinite banking, but more importantly, I think what was super evident in our latest Hawaii retreat was the relationships with the other people who don't think you're crazy for investing in things not in your 401k, taking equity out of your house, not paying it down, and going into deals with a bunch of random strangers on the internet. And this it's kind of a little bit of a cult, I will say, but it's a fun cult. And I think it's a cult that kind of helps people get to where they want to be financially. If you guys are interested in applying, go to simplepassivecashflow.com/journey. We have biweekly Zoom conference calls, but more importantly, all members are encouraged to reach out to all. We have about like at least 80 members today and build relationships. You never know who you'll meet. Other than that, you know, I think that's we try and protect our group and the identity of our investors. We're really the only group out there that is just pure, predominantly accredited investors only at this point. Definitely not what you're going to find at the local RIA, which is a bunch of house flippers and wholesalers, people who feel like they hear real estate's a great way to get rich and they don't have any money yet. But yeah, check out my book, The Journey to Simple Passive Cash Flow. You guys can check out me reading it out aloud if you guys like the audiobook version at simplepassivecashflow.com/book. And just kind of recapping some of my own stuff. If you guys have any questions, please type it into the chat. First thing, the book came out. I got the bestseller. So for a while there, I was at the top there, and now I can die happy. And now my parents will be happy and proud of me that I wrote a book. And they still will wonder what the heck I do all day long when I'm not an engineer. But how did I get a little contribution? Well, we had the Hui 4 in Hawaii. I think we had like 75 people show up. Um, Man, there were people were like dropping like flies because the week prior everyone was getting COVID. I don't know who was going to make it, but we had like about 75 non-COVID carrying people, and um, had a great time in paradise. Hopefully, people learned a little thing or two, but I think everybody had a lot of fun. Um, some significance. We redid some of the numbers just to keep track of it. Over $1 billion of assets under ownership. 130 million from folks like you. We're 50 projects now. I guess we did hit 50. 7,700 total units. 644 investors like you, but more importantly, 78% of you have decided to come back and play with us again after the first year. So that's kind of cool. Some uncertainty is good in your life. For me, the Chase Creek apartments are pretty much built. We're still waiting on like a transformer, so there's no power yet. But we are deciding to actually move forward through the lease up stage. We had an offer to buy this, but we are more interested these days. We think we can kind of push this project more and get even more returns by least going through the lease up phase, which is a little uncertainty, right? But I think the team decided that that uncertainty and that that small amount of risk was definitely worth the reward by taking it a little bit longer through that. How do I get a little more certainty in my life? Well, we expanded the team yet again. Chad Wong, some of you guys have been interacting with him. He's the new director of investor relations, and he's also our community manager in our family office, Ohana Mastermind Group, the FOAM. He is an ex-engineer. He likes answering your guys' questions, and it allows me to kind of spend my time on more business development opportunities, finding lenders, and kind of working on some behind the scenes stuff that maybe you guys will see here in the near future. Um, Team at Simple Passive Cash Flow, you guys can reach out to him. There is his email. And then a little bit of love connection. So that was a picture of one of our buses. That's not the VIP bus, but that's one of the buses there. And then we did have some champagne at the retreat one of those nights. Can't remember which one it is. And then just for fun, something I bought recently was this like 30-pound weighted blanket, which is just massive. It's super heavy. If you're in the market for a weighted blanket, bigger, heavier is the better, as they say. But with that, that was another report. I will put these guys up at simplepassivecashflow.com/investor letter. If you haven't yet, join our community and check out the website. There's a whole bunch of goodies in there. If you guys want access to the free Hui e-course, go and sign up at simplepassivecashflow.com/club. And if you guys have any questions, send an email to team@simplepassivecashflow.com. All right, we'll see you guys next month. Bye.